Welcome back. MultiChoice has had a tough year. That's as a weak macroeconomic environment characterized by elevated inflation and currency woes in Nigeria saw it report a 9% decline in active subscribers. This further resulted in a 5% fall in revenue, and its headline loss per share more than doubled to 715 cents. And joining me now to help us put the numbers into perspective is company CFO Tim Jacobs. Thank you so much for your time, Tim. Let's actually start off with that top line. I understand that group revenues declined by 5%, but on an organic basis, there was growth of 3% there. Was that all the inflationary pricing that you implemented?
Hello, Zanati. Thanks for having me on. So I think two things. I think in the South African business, we managed to put through an average 5.6% price kind of across the board. In the rest of Africa, of course, we've seen significant inflation across some of our core markets. And in many markets, we actually had to put in 2 price increases last year just to split the impact for the customer so that they didn't get, in a lot of these markets, you're seeing inflation kind of approaching or going over 30%. So we split them into 2. And what that allowed us to do was get some good pricing into the markets and, of course, offset a very, very difficult consumer environment, in particular in the African markets, where we see in some instances, like in Nigeria, you're almost competing for foodstuffs. It's as bad as that on the ground.
Well, that's the thing, Tim, because obviously you have to implement these, this inflationary pricing. But would you say that that maybe played a role in terms of being a dampener on demand? How are you working that out? Just protecting your own revenues, but also accommodating the consumer?
Yeah, so we try as far as possible to limit the impact on consumers. We try not. So, for example, when the currencies are really going, ballistic, like we've seen in this past year, at a trading profit level, in the last 5 years, our business from listing to 2023 incurred a cumulative 4.3 billion foreign exchange loss. We've just incurred a 4.5 billion rand exchange loss in a single year. Now, obviously, in those contexts, you're not going to go to the customer and say, well, I'm going to try and recover the cost of currency movement, but what you have to do is at least try and recover your inflationary price increases, and then soften it by spreading that increase over more than one increase in a market.
All right. Well, we've spoken about revenues and demand. Let's talk about your cost reduction drive. With that, you went above and beyond, and you're still saying that you want to do more. Are you on a sustainable runway of cost reduction?
We believe that we are. I think the one thing, like we always maintain, if you're going to operate in Africa, there's many things that you don't control, but you can't play the victim, right? What you have to then do is you have to cut your cloth to fit the circumstances. Right now, our circumstances are a consumer that's under massive pressure, right? And we're seeing that affordability come through in the lower subscriber numbers. That's a reality. And the second issue is that we've got these currency movements. Now, outside of that, we have a business that we can operate in a variety of ways. So this last year, we managed to deliver 2 things: a 1.9 billion recurring cost saving, and secondly, we reduced our subsidies by 1.5 billion rands. So the combination of those 2 allowed us to deliver a trading profit organic growth of 24%. We actually delivered 12.4 billion rands of trading profit before that 4.5 billion of currency impact that took us 21% negative on reported trading profit. So just to put that into context, now you asked a question about the future.
Yes.
We've actually accelerated that program that we saved 500 million rands last year in the first half, and another 1.4 billion rands in the second half, and we've actually accelerated that further. So what we're looking at over the next couple of years is a sustained attack on the cost base, rethinking every part of our business. And part of that is the reason why, for example, you've seen an impairment on our TechMod project, everything including capital expenditure, where we've got a number of years to go to completion, and it's going to cost us a significant amount of money to do that. If our current systems are good enough, we've decided to just stop those programs and then take the impairment charge on the amount of money that we've already spent. But we believe that will enhance our cash flows as we go forward.
Well, as you're talking about capex, I do understand that your capital allocation has been tight. And I do also understand in that you're still continuing with the investment into Showmax. Where are you on that investment into Showmax, but also really what are your main capital allocation priorities, at least in the medium term?
Yeah, so the good news in our business is that all three of our verticals have made significant strides this last year. Showmax, big investment. I mean, if you have a look, in total, we've invested 4.1 billion rands of cash flow in Showmax this year to do two things. One, to put in a new platform, to convert all of our customers onto that platform, and to build up the right amount of content in working capital in order to be able to really attack the market and give the customers something unique in the year ahead. We've managed to do all of that. We've gone live. We managed to migrate 100% of our customer base, and 88% of the customers that we migrated have already reactivated on the new platform. So very happy with Showmax's performance. Moment is the second big investment that we've been making. That's a business that's been in development mode now for a while. They're taking over our digital payments and our entire payment network. And as we sit today, they are taking over 30% of all of our payment volumes in South Africa already. They are one of the key payment providers for the Showmax platform. And by the end of last year, they were already taking $85 million of payments from the South African business already. So that is a business that is very quickly now ratcheting up. They're now going to expand into our other markets and start taking over the payment solutions there. So very happy with Moment. Is now revenue generating. It is no longer just an investment cycle. They're now generating income. And of course, the last investment that we've made is in Kingmakers, and there they've launched the SuperSport Bet franchise in South Africa. And we're seeing some very nice early traction. Obviously, it needs to build up its brand name in the marketplace, but we're very happy with where that is positioned right now.
All right. Well, thank you so much for detailing that progress for us and really just highlighting some of the key things that came out of those numbers. Tim, that was the CFO of MultiChoice, Tim Jacobs.